The jobs report that came out today was well above everyone's expectations, quote, flying in the face of Fed rate hikes. You also have Bank of America that published their 2023 outlook, which they expect the stock market to fall 24% from current levels. They expect a recession in Q1 2023, and they also expect the S&P 500 to reach the 3,000 level, or if you track the S&P 500 using the SPY index, they expect that to fall to about $300 even. You also are going to experience this recession in 2023 if the yield curve inversions mean anything. So we're going to get into this whole entire situation. We're going to look at what's happening today with the dollar, with the bond market, with the actual charts here, because I'm still very concerned with what I am seeing, but there is some positives out of today. And the first positive is going to be the fact that payrolls were strong. And why do I say this is a positive? Well, it's not necessarily a positive for equity prices because, as you can see, the stock market is down. S&P, NASDAQ down about 1%. The Dow is doing a lot better, but still, everything is in the red today. And that's because it's, quote, flying in the face of Fed rate hikes. This is not what the Fed wants. They don't want to keep adding 250,000 jobs every month, and that is what is happening. Now, the positive part of this is that you are adding jobs, that every positive beat we get to payrolls really pushes back the whole recession argument, because how do you get a recession when people are not losing jobs, when you're still adding 250,000 jobs a month? Now, this won't last forever, but for right now, backwards looking, it looks pretty good. At the same time, inflation is coming down. So as long as inflation does not tick back up on the November reading coming on December 13th, that's going to be not this next upcoming week, but the week after that. It falls on Tuesday. As long as that CPI report does not indicate inflation is going up, as long as it does continue coming down, I don't think the Fed, wants to crush the job market necessarily. And that's why I think the markets are not down 2 to 3% today. It would be a much different story if the last CPI report we had gotten showed inflation going up. But that is going to make this next reading of inflation so much more important. And fun fact, you have Fed Jerome Powell the day after the 13th, the 14th. He is going to give his FOMC statement. The markets are firmly pricing in 50 basis points at this point, but it's all going to depend, on how long they keep rates in restrictive territory and how high they have to go. And a lot of that will be based off of that CPI report, which will come the day before. But let's get into some of these numbers, guys. So non-farm payrolls increased 263,000 for the month, while the unemployment rate was 3.7%, the Labor Department reported Friday. The payrolls number was well above the 200,000 estimate, while the unemployment rate was in line. Average hourly earnings jumped 0.6% for the month, double the estimate, and 5.1% annually versus the 4.6% expectation. So on one hand here, this is a positive thing, like I said, because the jobs are not declining. It's hard to say you are in a recession, at least currently, when you're gaining 250,000 jobs in the last month. How do you have a recession if you're not actively losing jobs? And you are seeing inflation coming down at the same time. So that is also a positive thing, because the Fed doesn't necessarily have to push the economy into hundreds of thousands of job losses every month if inflation will just come down. That is the difference between the hard landing argument and the soft landing argument. So that's why the markets are not down 2 to 3% today, because inflation did come down at the last CPI report. And that's why December 13th, the FOMC meeting is going to be so important, coming the day after the CPI report, coming on December 14th. CPI report will be on December 13th. Let's be clear about that. Now, the other factors, guys, is this whole recession argument. And I think it's pretty clear from this point, there will be a recession. And Bank of America just came out with something very interesting. And they are expecting stocks to go down 24% next year, and they expect a recession will ravage the markets in Q1 2023. So let's take a look at exactly what they are saying. This is quote by quote what Bank of America just put in their report. So it says, Bank of America economists expect the U.S. to slip into a recession in the first quarter of 2023. That will become the dominant story for the markets next year, the bank said. The S&P 500 could plunge 24% from its current level by the end of the year, strategists warned. And if you continue down, they basically cite high employment, and they also talk about margins decreasing, because when you're not able to grow your top line revenue, like it's hard during a recession to add more customers, right? The average business is not going to sell more goods and services. So what they end up doing, they end up cutting costs and cutting jobs. Well, that does eat into margins, and it's hard to get that margin expansion to a certain point. So that's how it ultimately affects fundamental valuations. Like, even though a company might be able to grow their EPS, call it by 5%, if the revenue is flat on the year, how are they making those extra, 5% to their EPS? They're cutting cost. And, that's a good and bad thing. You don't want to see a company just growing by cutting costs. You're not really growing at that point. And it says, quote, the bad news is in 2023, the process of unwinding easy money could start to impact the economy, they said. And it's not just a recession that will rattle markets next year. According to Bank of America, rising interest rates, red-hot inflation, war in Ukraine, and the environmental crisis will also carry on spooking investors. Quote, the biggest rate shock in history, the most aggressive hiking cycle, the biggest inflationary pressure in 40 years, rising recession fears, wartime and ongoing geopolitical risk, urgency building around carbon emission reductions, suggest macro will loom large in 2023, the team led by Sumrarian said. All these factors played a key role in the stock sell-off that has seen the S&P 500 plunge 17% in 2022, they noted. And obviously, it was a lot more than that at one point, but you're still down, roughly 17%. And it says, quote, the market typically bottoms 6 months before the end of a recession, so buy in the first half based on our economists' forecast of the recession ending by the third quarter of 2023. So they're basically saying it's going to be a rough first half of 2023. The second half of 2023 should be a lot better. And from their forecast, they are not expecting a deep recession. They're just expecting to get a recession. And there's a lot of people that are in the camp that a recession is not going to happen. But if you look at the yield curve inversions, I think the argument is there's really no argument, right? People are saying, still not going to see a recession. But how come every single time you have seen a recession before, you have yield curve inversions in which the 2 and 10-year bond yield curve right now is so deeply inverted? It's at its most inverted levels since the 80s, since people started to track this. And actually, it's much more inverted today than it was even in the 80s. Now, some of the other yield curves were more inverted in the 80s, like the 3 and 10 year, in which we're going to talk about in just 1 second. But every time you get this inversion, you have seen a recession in the past. Now, let's take a look at a chart that is a little bit more relevant, and I think a lot of people pay more attention to this chart, and it's the 3-month 10-year spread. So essentially, when you're thinking about a yield curve inversion, let's make it very simple. Don't think about anything else, but actually think about this in logical terms. So if you were to invest your money in bonds, would you expect to get paid out more in 3 months or in 10 years? If I could tell you, if you invested $100 with me right now, and I will give you $200 back in 3 months, or if you invested that same $100 with me, I would give you $150 back in 10 years. What makes more sense? Obviously, the 3 months. And the question is, why would you invest your money and get paid more back in a lot less time? That's the argument of recession. That is basically saying the Fed's going to have to cut rates, after that 3-month period, and those rates are going to be a lot lower over the next 10 years. So it's basically saying, guys, you're heading into the gulag here. You're going into a deep recession. And as you can see right here, this is the actual chart from history. And the historical average is for a positive 1.52% yield curve. So essentially, you should get paid out 1.52% more over the course of 10 years rather than 3 months. Well, you are at almost a 1% inversion level. So essentially, you're getting paid out like 4% right now for a 3-year bond, and you're getting paid, or 4.5% for a 3-month bond, sorry, and you're getting paid out about 3.5% for a 10-year bond, which you can see is actually about right on where the 10-year bond actually is right now. Yeah, about 3.54% is where a 10-year bond is. So that should not be happening. If you take a look back here, you are the most inverted that you have been since the 80s, still slightly more inverted than the dot-com bubble, but you can see the 70s super inverted followed by a recession. Back here in the 80s, every single time super inverted followed by 2 recessions, slightly inverted followed by a recession, inverted recession, inverted recession, inverted recession. Now you're inverted, waiting for that recession. So I think there's a lot of questions in the air of how deep or how long this recession would be, and a lot of it depends on credit risk. Is there, a big credit risk? Is there going to be a lot of defaults? Are people going to massively lose their jobs? That's going to be the difference between an 08 style recession and a COVID style recession, right? And I think this would be somewhat in the middle. I would expect maybe a 6-month recession. I'm kind of in the line with Bank of America. I don't really expect it to be a massive depression unless, inflation remains high and the Fed just has to get people out of work. In that case, anything is possible. But nonetheless, guys, it's not looking so good. And if we take a look at the day, what is happening in the S&P 500? The S&P 500 is down about 0.62% on the day. Not all too bad. Whereas you are actually seeing the bond yields going down again today, and you're seeing the dollar going down again today, which should be bullish factors, but you're seeing the markets down. And why this is so very concerning is because this is what happens during a recession. Bond yields go down, the dollar goes down. This is an indication of a recession, and the more days that you have bond yields going down and the dollar going down and the stock market is also going down is telling you we might already be in the making of a recession. And that is something to pay very close attention to. As I've talked about a couple times here now on the channel, you have seen the price of gasoline coming down. It's not that there's still, not this supply and demand imbalance. It's quite possibly due to the recessionary factors of this market that are pricing in a recession. Because think about 08, right? Gas, I remember I was a lot younger. I didn't drive, obviously, but I remember the parents talking about, $4 or $5 gallons of gas, and then it wasn't a problem anymore because it went back down to like $2, within 3 to 6 months once the recession started, or even before it was technically started. It went down in a massive way. And that's what you are seeing right now, guys. So I would just be a little bit careful here. The next 3 to 6 months, I would expect more talk about a recession, possibly going into a confirmed recession. You already had the first half of 2022 in very negative territory. The last GDP report we got was good. A lot of people called it artificially good because of inventories and supply. But this next reading, I think, will be a lot more important for the markets, especially around that GDP print and the, are we in a recession or not? Are you seeing these things happening in the markets because you are in a recession? And the best way to actually position for this is to hold a lot of cash. Now, I don't like the indexes at these prices, but I do like a lot of your beaten down technology stocks that have free cash flow, that can sustain themselves, and that have sticky business models, right? I do like a Square. In reality, they would probably lose some money during a recession as well. But do I think they would start losing a lot of money? Do I think they would actually lose money? Their free cash flow might go down. Their profitability might go down a little bit. But the stock is already priced for that. So it's not like that would be new news, right? The stock's beaten into the ground. It's got free cash flow. Those are some of the things that I would look at. Something like a Crocs as well, that is following the trends of, this day and age. Crocs, they own Crocs. They also own those shoes, Hey Dudes. Everyone wants a pair of Hey Dudes. That's something I've seen in my personal life. And, companies like that are cash flow machines or profit machines, those are what you want to own. But I wouldn't play into the whole own oil stocks or own, what are some other staple companies, right? Your toilet paper brands or your dish detergent brands, Colgate. I'm not going to own those kind of stocks. I don't think that's where the return is over the next 5 to 10 years. But you just want to make it through this recession, and you want to have money on the sidelines. You want to have money on the sidelines because when everyone's bleeding out and when everyone's feeling the pain of the markets, you want to be able to step in and start buying things. During the Great Depression, more millionaires were created than what the lottery has produced ever since then. So think about all of the lottery winning millionaires. There was more millionaires created during the Great Depression than what you have seen in all history of the lottery. That tells you something. People that had money made a lot of money once the recession actually came, guys. So that is it for this video. Let me know your comments, questions, thoughts, concerns, whatever you got for me down below in the comment section. Hit that like button and most certainly subscribe to the channel if you made it to the end of this video. Thank you guys for watching, and I will see you in the next one.